Well, the world is changing fast, isn't it? It's hard to keep up with it all, and I completely understand. It's one of those things that we're monitoring everything going on in Iran right now. Obviously, there could be investment implications from this. At the time of recording, it seems like the market reaction, it's already priced in a lot of the risks associated with that, and the market's already priced in the fact that Iran probably can't shut off the main waterway that controls most of the shipping and exports for oil and everything like that. To them, it would be like economic suicide. It would be like the United States blowing up Apple's factories or something like that. It's not likely to happen unless they're backed into a corner enough to do something like that. Now, that being said, it is something we're watching. There are certainly investment implications and implications to inflation and the Federal Reserve, what they do with interest rates if this continues to escalate from here. So it is something we're watching. But one of the things that we're watching a little bit more closely, because it does have a direct impact on your life, is the one big beautiful bill that Trump and the House and the Senate are working on getting passed. There are tax implications that go into that, and also some deficit and government debt implications that we're looking at with that. So before I get into everything on that bill, I just want to start off by saying I'm Zachariah Montera. I'm a private wealth manager and certified financial planner here at Fross and Fross Wealth Management. We're located here in Central Florida, where we help retirees and pre-retirees plan and navigate situations like this with clarity, confidence, and a plan. And so with that, I'll go through just really three main points of the one big beautiful bill that I want you to know about and to be aware of that could impact your personal situation. Number one, tax on Social Security. Unfortunately, one of those campaign promises about no tax on Social Security, that's not going to be happening. That is not found anywhere in the bill. What is made up for, or a way that they're trying to make up for that, is by adding an additional standard deduction for seniors of $4,000 on top of the normal extra standard deductions you get at age 65. And so that will help out certainly with your tax ramifications of anything with your income over the next couple years. That does expire at the end of 4 years, so that's only good for 4 years. However, it does make the increased standard deduction that took place in 2017, that made it so most of you can't itemize things. That provision is in there to make that permanent, meaning you probably won't be able to itemize unless you have significant medical expenses, significant charitable contributions, or you happen to have a property in a state like New Jersey, California, or New York, where the property taxes are so high that you're able to take advantage of the increased SALT cap. The SALT is the state and local tax deduction. So let's say that you paid $40,000 a year in property taxes in New York. You could use that as a deduction instead of the standard deduction. So that is a provision that's in there. Right now, that made it through the Senate. And so for those of you who have homes up in New York or New Jersey, and maybe you end up shifting your homestead up there because it would make sense for you to have your income there, because it maybe in the end it would actually save you on taxes to do that with this increased SALT cap. So that's certainly a consideration. Aside from some of those tax things, obviously it extends the Tax Cuts and Jobs Act. So all of our tax rates that are applicable for the last couple years, none of that changes. Instead of getting a tax increase, everything just stays the same. And then also with the estate tax limit, the amount of money you can give away upon death, the death tax, sometimes it's referred to, stays at about $13.6 million per person. So it really doesn't affect many people, but it is something that we've been watching and planning around for the last couple of years. So that is something that we're watching. And really, most importantly, what we're watching is modeling out the different projections of inflation, growth rates, and what this does to the deficit. And I will tell you this, we ran our own numbers using our own simulations of what can happen over the next 10 years. We do that by using what's called a Monte Carlo analysis. If you've ever done a financial plan with us, you would know there's a little number in there that says probability of success, meaning how likely are you to not run out of money or meet all of your objectives that you have in your financial plan. We do that by simulating 1,000 different scenarios of down markets or higher inflation or higher taxes or increased spending, all of these different things. And after 1,000 different scenarios, we come up with a figure and it says, well, out of all of those 1,000 trials, the average is about a 90% probability of success. So that's great. Really, again, if you've done a financial plan, you're aware of those. So we did the same thing with the budget and the deficit. And this is what I'll say about that, is that in the most optimistic cases and in the most optimistic trials through that simulation, where we have very high growth rates in the economy and everything else stays somewhat relatively stable, it has no impact really on the deficit. The deficit still stays at about 5% of GDP. Think of that like you're bringing in $100,000 in income per year, but you're spending $105,000 a year. Think of it like that. And so you're just building onto that debt every year as time goes by. In the most optimistic cases, it stays at 5%. The median is that by the end of 10 years, we're probably looking at somewhere around a 7 to 9% deficit to GDP annually. So that same example, you're making $100,000. Now you're spending $109,000 a year. So you're just building on top of your debt every single year. If we get a recession in the next 10 years, that figure probably becomes 18 to 20% of GDP. So unfortunately, what the bill that's in place right now will not do much to help out the government debt situation. In fact, it's probably going to make it worse in a lot of cases. But this is something we've known for a very long time and have, if you've been to any of our State of the Markets or halftime reports over the last couple of years, you'll know that regardless of who's in office, this situation gets worse every single year and continues to get worse every single year because the cost of fixing it is politically impossible right now. And so again, it's something that we're watching. What does that mean for you though? Well, think about this. Over the last 2 years, we had high deficits around where we're at today, and the market had double-digit back-to-back returns in 2023 and 2024. So realistically, it's very possible that the market continues to do well from here, especially if this gets passed in its current form. And in terms of impact to your assets and your investments, probably doesn't have much of an impact as of right now. And so again, it's something that we're watching, but I just want to give you a couple things that we're looking at with this bill. And obviously we're watching the situation in Iran. If you have any questions, feel free to reach out to your advisor here at Fross and Fross. As always, we're here for anything you need. Take care.